guys, Kirk Pugh here with KBT Realty in Wilmington, North Carolina. And this is a first for me, doing a one-person Zoom meeting so that I can share some information with you all. I get a lot of questions every day about the real estate market and whether or not we're going to see a repeat of 2008. And I just wanted to run through some stats very quickly with you guys and show you why I think we are not in 2008. So I'm going to fly through this real quick. And the basic premise for me is that 2020 is different than 2008, and that COVID-19 as it relates to the real estate market is just a pause. First, let's look at mortgage lending standards. You can see from the notes under here that mortgage credit availability, meaning mortgage lending standards, have gotten tougher since December of last year. So mortgage credit availability decreased in both December, January, and February. My guess is that we'll see that trend continue in March. So that's a difference than what we saw in 04, 5, 6, where basically anybody that could fog a mirror got a mortgage. I want to take a look at the housing credit availability. You see it's decreased by 5.29% in the third quarter of last year. The total default risk by the mortgage lenders, if you look back in 2005, 2006, was very high. And then you go down to the current date, 2019, 2020, much lower than when we had the bubble burst in 2008. Let's look at the 3 years prior to the bubble bursting in 2008. So leading up to the crash, the 6 years, we saw home price appreciation anywhere from a low of 6.5% to a high of 12.5% in 04. These are national numbers. I will tell you that here in southeastern North Carolina, that appreciation during those 6 years prior to the crash were much higher than that. We were seeing appreciation in the 17, 18, 19, 20% range. And now look at the home price appreciation in the last 6 years leading up to where we are today. Much more moderate, sustainable growth in our home prices. 17, 18, 19, 17, the highest at 6.4%, and pretty steady at 4.8, 4.7 in both 2018 and 19. Let's take a look at surplus homes. This is courtesy of National Association of Realtors. Premises that a 6-month supply of inventory is a balanced, healthy market. Just before the crash in 2007, we had an 8.2 month supply. So you might say a glut. It was definitely a buyer's market. And today we have a 3.1 month supply of inventory. And that is definitely a seller's market. So inventory is very tight as it has been. Also want to look at affordability. So in 2006, the average consumer was spending 25.4% of their median income needed to purchase a median priced home. Today, that number is down by almost 10%. So the affordability factor is definitely greater today than it was then. And let's take a look at how much equity consumers had pulled out of their houses. So in the 3 years leading up to the crash, there were cash out refis in the amount of $824 billion, meaning that when prices dropped in 2008, so much equity had been pulled out of their homes that sellers were forced into what I would call a short sale situation, or they were absolutely underwater. And now look at today, in the 3 years prior to where we are, 17, 18, and 19, a total of only $232 billion taken out in cash out refis on their homes. Tells me that, first, that number is roughly 25% of where we were back in 2008, 12 years ago, and that people have learned their lesson and they are protecting the equity in their homes. So even if we have a temporary dip in prices, certainly the equity is still there, and many homeowners will not be in a situation where they're upside down in their homes. One important point that I want to bring up, and I've seen it scattered about on social media and other places, federal government has issued a moratorium on foreclosures, and they have mandated forbearance. It's really important to understand what forbearance is. It is not forgiveness, right? So most lenders are going to offer you a plan where you can pause, for lack of a better word, your mortgage payments for the next 90 days. However, what they may not do a great job explaining to you is that in month 4, not only is your mortgage payment due, but all 3 mortgage payments that you have paused are going to be due at that time. So common wisdom right now is saying, if you can make your mortgage payment, make it. If you can't, you need to talk with your bank, and you need to make sure that there is a written understanding of what you can and can't do. Make sure you know what the rules are. And let's talk about whether home prices go up or down in a recession. Going all the way back to January 1980, GDP was down 2.2%. Home prices were up 4.5%. 1981 to 82, GDP down 2.7%. Home prices up 1.9%. Let's see, GDP, July 1990, I think that was the tech bubble. GDP was down almost 1.5%. Home prices were down slightly, but less than 1% overall. 2001, home prices up 4.8%, while GDP was down. And then, of course, we had the Great Recession, December 07 to June 09, where home prices definitely took a hit. But that was sort of a different thing. The housing market created that bubble, and it was compounded by the financial markets. The other thing I want to say, if only to reassure my peers, my fellow realtors out there, and you as sellers and buyers, at the peak of the market in 2006, there were nearly 6.5 million homes sold and bought across the United States. And in the worst depths of the recession in 2010, there were still 4.5 million homes that were sold. So our market is definitely changed. The way that we go about business is changed. And the way that we conduct ourselves when showing homes, doing listing presentations, doing buyer consultations, all of that has changed. And even if we have a slight dip in the market, the market's not going to stop. People need to sell, people need to buy for a variety of different reasons. And I would say if you don't need to sell and you're content to be where you are, stay there. That's okay. If you do need to sell, we have the technology, we have the skill set, we have the marketing, we have the market expertise to be able to represent you properly and appropriately. And if you're a buyer, we can make that transaction happen too in many virtual ways, most of which is completely hands-free, hands-off. So I hope this information helps you understand where we are today versus where we were back in 2008. And if you have any questions, you can always call me, 910-622-3478. You guys be well and be safe.